Today we're diving into one of the most powerful concepts in investing, the dividend snowball effect, also known as the power of dividend investing through compounding. Imagine starting with a small snowball at the top of a hill. As it rolls, it picks up more snow and gets bigger, faster, until it's unstoppable. That's exactly what happens when you invest in quality dividend stocks and reinvest those dividends instead of spending them. In this video, I'll explain how it works, show real math examples, including what $10,000 could become over time, highlight why 2026 is a great time to start or accelerate your snowball, and give you actionable steps to get going. But first, the basics. Dividend investing means buying shares in companies that pay you a portion of their profits regularly, usually quarterly, as a thank you for owning the stock. The S&P 500's average dividend yield right now in March 2026 is around 1.15%. It's not huge, but reliable companies pay much more. Think 3 to 6% when investing in Dividend Aristocrats. And those are the companies that have raised dividends for 25 years or more, or even higher from strong players. But here's the key. Most people cash out the dividends and spend them. Smart investors reinvest them via a DRIP, a dividend reinvestment plan, automatically buying more shares with the dividend cash. No extra effort. Why does this matter? Because of compounding, earning returns on your returns. Albert Einstein supposedly called it the eighth wonder of the world. With dividends, it's on steroids because the income itself grows as companies raise payouts over time. So picture this. You invest $10,000 today in a diversified portfolio yielding 4% on average, which is realistic for a quality dividend stock or ETF in 2026. Higher than the market average, but achievable without crazy risk. Now, in year one, you get $400 in dividends. If you spend it, the portfolio stays around $10,000 plus or minus the market moves. Now, if you take that $400 and you reinvest the dividends to buy more shares, now you own $10,400 worth of stock. Then we see in year two, you'll receive dividends on the new larger amount, somewhere around $416. Then you'll continue to grow your base, assuming that you continue to reinvest it again and again and again. Now, over time, the number of shares explodes. Add in 5 to 7% average annual dividend growth, which is common for Dividend Aristocrats, and then 4 to 6% price appreciation. Your base begins to snowball. The following is a conservative example. You have an initial investment of somewhere around $10,000, that starting yield of around 4%, annual dividend growth of around 6%, and then the share price growth of around 5% per year, times the full reinvestment. After 10 years, your portfolio grows from $10,000 to approximately $28,000 and paying you $1,200 to $1,500 per year in dividends. After 20 years, your portfolio grows to approximately $75,000, and that's paying somewhere around $3,000 to $5,000 per year. After 30 to 35 years, your portfolio could reach somewhere between $200,000 to $400,000 and generating $10,000 to $20,000 in annual passive income, which is enough to cover big chunks of expenses. Now, what's the magic? Early years feel slow, like pushing a tiny snowball, but around year 10 to 15, momentum kicks in. Dividends start buying meaningful new shares without you adding fresh money. That's when it feels unstoppable. So let's scale it. Start with $50,000, which it sounds like a lot, but it is achievable via consistent saving and investing. We will use the same assumptions and a 25 to 30 year time horizon, and bingo. The portfolio would increase to approximately $500,000 to $1 million and paying somewhere around $20,000 to $50,000 per year in dividends. Many retirees live off this. Real world proof? Look at Dividend Aristocrats and Kings in 2026. Companies like Procter Gamble, Johnson & Johnson, Coca-Cola, or even an ETF like Schwab's U.S. Dividend Equity ETF that trades under SCHD. Let's zoom in here and we'll look at the 4 standout Dividend Aristocrats that are excellent for building your snowball in 2026. These are battle-tested companies with decades of consistent raises, strong cash flow, and reliable payouts. First up, Procter Gamble, the consumer goods giants behind Tide, Pampers, Gillette, and more. As of March 2026, P&G pays an annual dividend of about $4.23 per share, with a yield around 2.6%, depending on the exact price. They've increased their dividends for 69 consecutive years, one of the longest streaks out there. Annual revenue is roughly $84 billion, and they generate strong operating cash flow, often in the $17 to $18 billion range annually, supporting their $10 billion in planned dividend payouts and buybacks this year. This is a classic defensive play. Everyday essentials means steady demand, even in tough times, perfect for long-term compounding without big drama. And that's exactly what we're looking for. Next, we got Johnson & Johnson, a healthcare powerhouse that produces pharmaceuticals, medical devices, and consumer products. Current annual dividend is $5.20 per share, yielding somewhere around 2.1 to 2.2%. They've raised it for 64 consecutive years, earning Dividend King status. Revenue runs somewhere in the ballpark of $94 billion annually, with solid operating cash flow backing a conservative payout ratio of around 50% of earnings, which is plenty of room for future growth. J&J's diversification across health care segments makes it resilient, and their consistent raises make it a favorite for income-focused portfolios. Whew, that was a mouthful. Then we have Coca-Cola. You know Coca-Cola, the iconic beverage leader with Coke, Sprite, and huge global brand portfolio. Annual dividend is around $2.04 to $2.12 per share, recently yielding somewhere in the ballpark of 2.7%. They've increased dividends for 64 consecutive years. Revenue is in the $47 to $48 billion range, with a strong operating cash flow around $11 billion annually, which is, again, easily to cover their payouts. Coca-Cola's moat from brand power and worldwide distribution means predictable income, and that steady growth makes reinvesting dividends way more of a snowball accelerator, which is beautiful. Finally, we've got Realty Income, known as the Monthly Dividend Company, a retail REIT owning thousands of properties leased to stable tenants like drugstores and convenience chains. The pay monthly, a big plus for cash flow feel. With an annualized dividend of $3.24 per share and a higher yield amount around 5%. They've increased dividends for around 30 years straight. That's 133 quarterly hikes, with revenues somewhere around $5.8 billion and operating cash flow supporting AFO coverage. It's more income oriented with the higher yield, but still focused on reliable monthly payouts and gradual growth. Great for those wanting frequent reinvestment boosts. These 4 show why aristocrats work. They have strong businesses, growing payouts, and cash flows that support the snowball without excessive risk. Pick a few, reinvest, and let time do the heavy lifting. I will say, with Realty Income, I'm going to be looking at that one a lot closer coming up here, just because of the space for which it operates in. Retail has been under a lot of scrutiny of late, and especially in these REITs, we really want to dive in and take a look at the numbers. So be looking for another one of those videos coming up here soon. So let's take a look at another example here. If we would have invested $10,000 in a basket of aristocrats 30 years ago and reinvested the dividends, many portfolios would be worth 10 to 20 times the initial investment today. With yields on cost of 10 to 20%, remember, we're talking dividends grow massively on your original investment. So that's what that percentage is in reference to. With your current standouts for snowballs building in March 2026, Medtronic, MDT, which is a healthcare study grower, Duke Energy, DUK, Utilities Reliable Cash Flow, and then, of course, Realty Income, which is the monthly payer, REIT Stability. These aren't get-rich-quick picks. They're get slow and steady. No time in the market required, which is exactly what you're looking for in this type of investment. So, the quick warnings to make good financial decisions. Number 1, avoid ultra-high yields, 8 to 10%, unless researched, often yield traps from struggling companies that are going to end up probably cutting their dividends in the near future. Also, look to diversify. Don't put everything in one stock. Aim for 20 to 40 holdings or use ETFs. And we'll be building a portfolio here and tracking it as well. 3, be patient. Snowball needs time to develop, roughly 10 years for real momentum. So start small if needed. Even $100 per month adds up. Also, taxes. Use tax-advantaged accounts like IRAs, 401ks to maximize compounding. Make sure you talk to a tax advisor about such structure so you do it the right way. The 5th, inflation hedge. Dividends growers usually beat inflation long term, which is a beautiful thing. So, how do you start your snowball today? It's easy. First, you open a brokerage account with a free dividend reinvestment program. You should check out Fidelity or Schwab. I think Vanguard might also have one as well. Research 5 to 10 quality dividend growers. Start with aristocrats or watch the DividendSphere channel for more dividend stock ideas. 3, invest consistency. Lump, sum, or dollar cost average in. And we'll cover those terms and those strategies in later videos. 4, set to auto reinvest. 5, track your progress. We will be developing tools like this and other spreadsheets. So again, you'll have something to kind of go off of and use as a good roadmap to attaining your goals. And remember, small, consistent actions today create massive wealth tomorrow. So start your dividend snowball now. Reinvest, stay patient, and watch it grow. If you're in, you want to do it, please smash the like button for this video. Also, subscribe to DividendSphere and tell me your target dividend income in the comments. Next up, we're going to talk about exactly how much you need to invest to achieve $1,000 a month in dividends. So see you there, and let's keep rolling it.